Welcome to this explainer. We're jumping straight into the underlying mechanics of corporate finance today to really help you think like a true practitioner. We're going to focus heavily on the real-world application of these concepts. Specifically, we're nailing down the absolute basics, the mechanical flow of the financial statements and the localized friction of UK taxation. Let's get to it.
So let's kick things off with a pretty provocative question to set our baseline. How do you actually allocate limited money over a completely uncertain timeline to create real value? Because let's face it, money is limited, but ideas for spending it, those are infinite. Finance, at its absolute core, is simply the skill of choosing well.
Here's our roadmap for this explainer. We'll cover the core philosophy, the three statements, connecting the flow, UK taxation essentials, and then we'll wrap it all up with the practitioner's mindset.
All right, Section 1, the core philosophy. Value and allocation.
You know, every single finance job out there basically boils down to just three fundamental questions. First up, the investment decision. What should the money actually go into? Are we buying a new machine or funding a massive marketing push? Second, the financing decision. Where does that money come from? A bank loan? Selling shares? And third, the returns decision. What happens to the profit? Do we reinvest it back into the business or pay it out? Honestly, if a topic ever confuses you, just step back and ask yourself which of these three buckets it belongs to.
Now think about why a pound today is worth way more than a pound tomorrow. Waiting actually has a cost. You could have invested that pound today and earned a return on it. Plus, prices rise, and the future is always inherently uncertain. So to genuinely compare money across time, you've got to translate it into today's money using a discount rate. This translation is called present value, and it is literally the heartbeat of all finance.
Which brings us to what is absolutely the deepest idea in corporate finance. You only create value when your return on invested capital is greater than your weighted average cost of capital. Think of it like this. If you borrow money that costs you 8% and you invest it to earn 12%, you create value. Easy, right? But if you only earn 6% on that 8% money, you destroy value. And the wild part is, that holds true even if your accounting books are showing a profit.
Moving right along to Section 2, the three statements measuring value.
Think of the income statement like a waterfall over a specific period of time. It starts right at the very top with revenue, and then it just subtracts costs step by step. First, direct costs get removed to leave your gross profit. Down from there, everyday running costs are taken out to leave operating profit, or EBIT. Finally, right at the bottom, interest and taxes are removed to leave your net profit. It exists to answer one simple question: did the business make money this year? But you've got to remember this golden rule. A business can report an absolutely glowing profit on the income statement and still go completely bankrupt simply because it ran out of cash. Profit is, well, it's kind of just an accounting opinion based on when things are earned or incurred. Cash, on the other hand, is a cold, hard fact. Your cash could easily be trapped in a warehouse full of unsold inventory or tied up in unpaid invoices, which is exactly why we desperately need the cash flow statement. Now, to figure out exactly where a business stands at one single point in time, we look at the balance sheet. And this statement must always obey one exact equation. Assets, which is everything the business controls, must equal liabilities plus equity. Literally, everything the business owns was funded either by borrowing, which gives you your liabilities, or by the owners, which is your equity. It has to balance every single time.
Okay, Section 3, connecting the flow, linking statements.
Interviewers absolutely love this next test because it really separates the folks who just memorized a textbook from the actual practitioners. So let's walk it through. If you increase a non-cash expense, like depreciation, by 10, what actually happens? Well, on the income statement, your pre-tax profit falls by 10. Assuming a 20% tax rate, your net profit falls by 8. But over on the cash flow statement, you start 8 lower, then you add back that full 10 of non-cash depreciation. So your cash actually goes up by 2. Crazy, right? Why? Because you just saved on taxes. And here is how that flows seamlessly right into the balance sheet. The new equipment value reflects your capital expenditure minus that depreciation. So the overall asset value is down 10 from the depreciation. But remember what we just said. Your cash is up by 2. This means your total assets fall by exactly 8. At the exact same time, that net profit from the income statement flows directly into retained earnings under equity. Since net profit fell by 8, well, equity falls by 8, total assets fell by 8, total equity fell by 8.
boom, the entire system balances perfectly. Understanding that linkage, that is the absolute core of financial modeling.
Let's jump into Section 4, UK Taxation, Essentials, Friction, and Cash Flow.
All right, so corporation tax is charged on a sliding scale based on the size of your taxable profit. And let me tell you, it acts as a very real, completely unavoidable cash outflow. For small profits up to £50,000, it's 19%. Between $50,000 and $250,000, you're looking at a sliding scale. And for profits above $250,000, it hits the main rate of 25%. Then we have the 20% standard VAT rate. But pay attention because here is a massive interview trap you absolutely must avoid. For a VAT-registered business, VAT is a balance sheet pass-through. It is not an income statement cost. The business simply collects output VAT on sales, reclaims input VAT on purchases, and just pays the tax authority the difference. If you ever put VAT in your revenue or cost lines in a financial model, that is an immediate glaring error. Don't do it. So the really crucial takeaway here is that the profit you report to your shareholders, it is rarely the exact same number you report to the tax authority. Why? Because accounting depreciation is not tax deductible. Instead, the tax authorities give relief through capital allowances, which follow entirely different rules and completely different timing.
And because of this difference, we have to use deferred tax. Say you claim a massive capital allowance today, right? You pay less cash tax right now. But we use deferred tax not as a real cash tax you're writing a physical check for today, but as a mechanism on the balance sheet to record that a tax saving today is eventually going to reverse tomorrow. It just smooths out those timing differences so your accounts are actually telling the truth.
Which brings us to our final part, Section 5, the practitioner's mindset, applying concepts.
A true financial professional doesn't just sit around memorizing formulas. They understand the whole narrative, connecting the basics, the statements, and those gritty tax realities. They know for a fact that finance is about allocating scarce capital over time to beat the cost of that capital. They treat the financial statements as an intrinsically linked chain, never as separate silos. And they always anticipate the real-world divergences that taxes create between reported profit and actual cash in the bank.
So as you step into your next role, I really want you to ask yourself this. Are you just tracking the numbers, or are you actually reading the story they tell? Because when you can read that story, when you can see exactly how an operational decision hits the income statement, flows through the tax, impacts the cash, and finally lands on the balance sheet, that is exactly when you stop being just a number cruncher and you become a highly trusted advisor. Thanks so much for joining me on this explainer, and I really hope this helps you build out that practitioner's mindset. Catch you next time.